to the Business Doctor TV show. We are here every week on YouTube streaming, and today our guest is John R. Rivers. John is currently owner and director of Straight Talk Financial LLC. He's in Boca Raton, Florida, where I wish I was today. And he says, and I believe him, where an educated consumer is our best client. So let me fill you in on John just a little bit. Some of his past experiences. He ran Prudential's Boca Raton, Florida office. He served as Director of Education and Training for John Hancock Boca Raton. He was a registered representative with Securian Financial. He was manager for American General AIG. Was an instructor for the Morton Schools of Insurance and Financial Services. John, welcome to the show.
Thank you, Dr. Stein. It's a pleasure to be here.
You are welcome. And I guess we should start with, what is your goal and purpose in this video today?
Well, my goal and purpose today is to just let people know that what I'm trying to do is bring financial literacy to all Americans by offering free education and professional advice to individuals, families, and business owners. Basically, I teach the average person the strategies of the wealthy. I teach them how to build and protect their hard-earned money and assets.
How about an example of how you can help others?
Absolutely. I call these the enemies of wealth. There's several of them. Let's look at a few of the most obvious ones. The first one is taxes. You know, the great Benjamin Franklin said there's only two things certain in life, that's death and taxes. The average American pays upwards of 20 to 25% in federal taxes alone. I teach my clients strategies on how to accumulate retirement savings that grow tax deferred yet are accessible tax-free.
Well, that kind of forces the question, is it legal?
Absolutely. You know, it's funny, when the average person finds a way to either reduce or eliminate taxes, they call it a loophole. But the wealthy call it information. So imagine not having to pay taxes on the growth of your retirement savings. However, this is completely opposite of what most Americans are doing.
Okay, so let's drill down a little bit. Could you be a little bit more specific about that?
Well, sure. The average American is told that the best way to save for retirement planning is to put money in a 401k or some other group qualified IRS plan, or to open up an IRA, an individual retirement account. The problem is that this is tax-deferred contribution and tax-deferred growth, which equals 100% taxable income. It's not all yours to keep. So how much of it do you get to keep? If you don't know what your taxes are going to be, no one knows. So it's not a very good way to plan accurately. I'd like to offer a couple of ways to emphasize why this is not good.
Sure.
First, let's say I came to you and I said, Dr. Fun, I want to be your business partner. You're going to put up all the money. You're going to handle it day to day. You're going to take all the risks. And in 30 years, I'm going to tell you how much you owe me. Would you be my partner?
No, of course not.
Well, that's exactly the deal that you're making with the IRS when you use these types of plans, because it's all your money, you're taking all the market risks and managing your account until you retire, and then the IRS is going to tell you how much you owe them in taxes. The other way I like to summarize it is to ask you to pretend you were a farmer. You had a small sack of seeds, you plant those seeds and it turns into an abundant harvest. As the farmer, would you rather pay taxes on the seed or the harvest?
Well, back to seed, of course.
I can teach you ways where you pay taxes on your seed only and not on the harvest. And there are different ways to accomplish this. The next enemy of wealth that I'd like to speak about is interest earned versus interest paid. You know, the great Albert Einstein said, those who understand interest earn it. Those who don't, pay it. Yet the average American household has anywhere from $16,000 to $20,000 in credit card and personal debt. the interest that they're paying on these debts are anywhere from 16 to 26%. Yet at the same time, they're earning practically nothing at the bank savings account, checking account, CDs. And if they earn 10% on their retirement accounts, they're happy with that. Where's the logic in that?
And they could do better.
Absolutely. Absolutely. Well, you know, the banking and credit industry is designed to keep you in debt. If you combine all the debt with mortgages, student loans, auto financing, etc., the average person or household gets trapped in an unmanageable situation.
So how can you help those that find themselves drowning in debt?
I can help these folks by teaching them how to pay off all their debt, including credit cards, mortgages, student loans, etc., in an average of 9 years or less, saving them tens of thousands, if not hundreds of thousands of dollars in interest, all while creating their own family bank. So instead of making the bankers richer, they're enriching themselves instead. Now, this is a concept that's been around for over 100 years. It's a concept that the wealthy use. People such as Walt Disney, J.C. Penney, Ray Kroc of McDonald's use it to bankroll their businesses when the banks wouldn't lend them money. It's one of the best secrets out there, and it works for individuals, families, and business owners. The next point I'd like to talk about, or the enemy of wealth that I'd like to address, are market losses. You know, the great John D. Rockefeller said, if I had to give financial advice, my advice would be to stay out of Wall Street. Imagine that, the wealthiest man ever in America telling you to stay out of the financial markets. You wonder why? Because he knew the inherent risks of market volatility. When it comes to savings, I simply ask my clients, can you afford to lose that money? And if the answer is no, they have no business in the market. And yet, most retirement accounts are in mutual funds or other market investments.
Well,
She had her 401k, obviously, in the market like everyone else. And I looked at it for her, and I noticed that she had a lot of her money in high-end tech stocks, things like that. And I mentioned to her that she was really at risk, that she should really consider, you know, maybe diversifying a little bit or getting into something that's less risky. Well, like most Americans, or people I should say, her response to me was, well, I made 18-19% last year in my 401k. How much did you make? And I said, well, I made around 11 or 12, and I'm very happy with that. She said, well, I made 18 or 19. I said, yes, but you're exposed. And she said, well, I'm fine. My advisor has done a great job for me. My 401k is over $250,000. So I kindly just said, okay, great. Just want to let you know what my opinion is as a professional. Well, a few months later, she called me drastically upset. Her $250-something thousand 401k went down to $70,000.
oh my God.
All because, why? She was unfortunately greedy. People see they can make 18%, so that's what they want to do. Bernie Madoff, everybody knows that name. The people that lost money to Bernie Madoff were the people that believed him when he said they could make 18, 20, 25%. So if you're being guided by greed, you're going to definitely suffer. There are products out there that can guarantee you'll never lose principal or interest and allow you to participate in market gains. There are ways to save money, like I said earlier, tax deferred, that you can access tax-free. So there's a lot of different strategies out there that can be used, and what I'm running into, or I have run into in my last 22 years, is people that are dealing with professionals that were either licensed years ago and are not keeping up with the education, or that simply don't bother to look at other avenues. I've said before, accountants and CPAs could be your worst enemy, and I've had people look at me like I was crazy. And I could give you another example. I sat down with a business owner, and he had what's called a SEP, a Simplified Employee Pension, which is another qualified retirement account. Meaning what? Not taxed contribution, tax deferred growth equaling 100% taxable at the end. when I explained to him that he could have put that money away in a manner that would have earned interest that he didn't have to pay taxes on, he laughed at me. He said that was impossible. And I had to remind him, I've been doing this for 21 years, and I said, and I'm sure your CPA probably knows about this. And he doubted that, and I said, well, why don't you bring him in? And he did, and we sat down, and when I went over what I was talking about, and in this example, it's about life insurance. Life insurance proceeds, the money, or I should say cash value that grows in a permanent life insurance, grows tax deferred and is accessible tax-free. How? Well, when I mentioned that, the CPA said to me, well, no, if you put that money in there, yeah, it grows tax deferred, but as soon as you go to take it out, you're going to pay taxes on that growth if you withdraw that money. And I had to reiterate that I didn't say withdraw. I said access it. And I said, isn't it true that you can access or borrow from your death benefit money tax-free? He said, well, yeah. When he said that, the business owner literally turned around and kind of friendly punched him. I says, what do you mean? And then he turned around to the CPA and said, well, but that's not how we do things. Which was hysterical to me and really got the business owner upset. And I had to remind the business owner that when I originally met him, I said, listen, when you bring your CPA in and I embarrass him in front of you, don't fight with him until I leave. Well, of course, the fighting started, and I asked him, I said, hey, I told you no fighting. Let me go. Well, I left. I wasn't maybe 10 minutes away from the office when I got the call to come back. And I had to go, of course, not just to help him, but within a few days I got a call back from the CPA saying, hey, I need to talk to you because I need you to explain this to my clients. Wow. So it's really amazing to me that people, just because someone has a title like a CPA or an accountant, that they think their word is God's word. And there's just no other options. But there's plenty of options out there. Another thing I look at is there's a huge school of thought out there, and I'm sure probably 99% of you have heard it. When it comes to life insurance, they'll tell you buy term and invest the difference. That's terrible advice. Why? Because if you're telling me to buy term, you're telling me I have no need for permanent life insurance. And there are many needs for permanent life insurance. So I ask an advisor, says, would you put that in writing that I don't need permanent life insurance? They won't do that. Okay? But buying term and investing the difference. Why? Because if you use this person, they get to invest your money and make money off of you for years while handling your money. But if you put that same money into a life insurance policy, overfund that policy, you're not paying him to handle that money for you, first of all. Message would be to at least be open and talk to other people. Seek different opinions. When you talk to your financial advisor or your accountant, ask him if he has any experience working with insurance and annuities and life insurance and those type of vehicles. And if the answer is no, then find somebody who can or who does, because the difference to you could be drastic.
We already know that banking products are not the answer. So what do we do?
Well, Dr. Fine, there are ways to guarantee 3 to 4 times the interest rate that the banks pay. And there are also better ways to save that will allow you to earn more interest by participating in market gains while protecting your principal and earnings from any market losses. I teach these viewers about these products.
Okay.
The next major one, and this probably hits home with you, are medical bills. Do you know that medical bills are the #1 cause of bankruptcy in America? Medical bills can be doctor bills, hospital bills, nursing home care, or care at home or in a facility, rehab, therapy, etc. These type of expenses can financially cripple anyone. I show folks how to protect their large assets, future income, and tax returns from any liens. Well, that's the next enemy of our wealth, is lawsuits. And unfortunately, we live in a sue-happy society. So my question to the viewers would be, are your liability amounts on your auto insurance, homeowner's insurance, business insurance, etc., are they enough to protect your assets, current and future income, and your tax returns from liens imposed by a lawsuit? It's incredible to me, Dr. Fine, how most people never consider this. And it's mostly because they're price shopping their insurance as opposed to accurate protection shopping.
Could you give us a couple of examples?
Absolutely. I have a client that carried their state's minimum liability coverage on their auto. She had an accident. She put 3 people in the hospital. The bills were in the thousands of dollars. And because she didn't have assets that they could attach to, they sued her and put a lien against her. She had to pay, or I should say, they took $800 a month out of her paycheck for over 20 years and kept every one of her tax returns until that lien was paid off. Remember at the beginning that I stated that my goal is to teach people how to build and protect their assets. Another example I can give you is a friend of mine who, because his home was paid off, he decided to cancel his homeowner's insurance because he thought it was too expensive.
Oh.
The deductibles are high. He was like, well, if I lose my roof, my deductible's $15,000, I'd have to pay for it anyway. So he canceled his homeowner's insurance, not realizing that he would be responsible or liable if anybody got hurt on his property. Well, he ended up hiring a roofer because he had a leak. The roofer put a 17-year-old worker on the roof. The young man had an accident, spilled hot tar on himself from the neck down. He fell off the roof, broke his back, both legs, an arm, and had injuries. And my friend was sued for $1 million.
What else, John?
Well, one of the things that could be an issue, or what I consider one of the enemies of wealth, would be premature death or dying too soon. This can be devastating to your family or anyone who's financially dependent on you. Anyone who's currently supporting another person financially and that is saving money for their futures, be it college tuition for a child, or retirement income and support for a spouse, or for the benefit of a disabled child, sibling, parent, or spouse, or if they simply would like to leave an inheritance to a family member, should strongly consider several types of insurance. In the past, folks would buy life insurance, health insurance, disability income insurance, hospital policies, cancer policies, long-term care policies. And the problem with that is obviously that those premiums can add up. It's very, very costly. But the good news is that the insurance industry has evolved, Dr. Fine. It's gone through an evolution process. I'll give you an example. Life insurance policies of today allow the insured to access death benefit proceeds if they should have an illness or an accident while they're alive. These include terminal illness, chronic illness, critical accident. So instead of having to buy several policies and paying multiple premiums, you could buy one policy, one life policy with a larger death benefit, so that if you needed the money because you became ill or had an accident or needed care, you could access it. But if you ended up not having to use it, you leave a larger tax-free death benefit to your family.
Not only is that cost efficient, but it's simple.
Again, I stress the need to work with a professional like myself that is not only an investment advisor, but also an insurance professional. And finally, Stan, there's the enemy of outliving your retirement income. I read an article recently that said that retirees and those facing retirement are more afraid of running out of money in retirement than they are of dying itself. And unfortunately, that is a reality for millions of future retirees and current retirees. And it's caused by improper planning, resulting from either not knowing how to save or not saving enough, saving in the wrong way. I touched on that earlier. Taking your retirement money in a lump sum distribution. The same odds as lottery winners who take a lump sum, they're broke in 3 to 5 years. Also, very few companies today give pensions. If you're one of those people that will receive a pension in retirement, do you know which distribution option is the best one for you?
So with a pension and Social Security, a person could live nicely in retirement?
Sure, but the problem is very few companies offer pensions today. That's why the government in their infinite wisdom created IRAs, 401ks, etc. But we already know the inherent problems with these types of accounts when it comes to taxes, restrictions, and distribution. And of course, the consequences of taking a lump sum distribution at the beginning of retirement. Another thing that I'd like to touch on is the issue of a pension. As I mentioned before, very few people get a pension these days. And what was a pension? A pension is retirement income for life. So if you're fortunate enough to get a pension, with a pension and Social Security, you could live okay in retirement. The problem is most people do not get a pension these days. But those who do, when it comes time to retirement, they have to pick an option as how they want that money distributed. There usually is option A or B, some know it as option 1 or 2. So who gets a pension? Firefighters, police officers, state, county, federal employees, etc. They get pensions. But what happens is when they go finally to retire, the question is asked, well, which option do you want, A or B? Option A is you get the max retirement payout until the day you pass. Option 2 is we'll give you less, but when you pass, we'll continue to pay your spouse. Well, 90% of them are married and have children, and they think, well, my goodness, what happens if I choose option A and take all the money and something happens to me in a couple of years? I'm going to leave my family basically without any money. But unfortunately, when they go to retire, they're talking to an hourly clerk in the Human Resource Department, and when they show them the options, they look at the clerk and go, well, what should I do? And they say, well, everybody does option B.
So how can you help?
Well, Dr. Fine, I like to teach people how to turn their retirement savings into an income they cannot outlive, and they can reduce or eliminate their taxes. You know, this reminds me of a conversation that I had with one of my doctors. I simply asked him, I said, hey doc, can I ask you a question? He said, sure. I said, do you currently have a plan in place that will guarantee you'll never run out of money in retirement? Now, here's a well-educated man, a doctor, and he looked at me and he said, yes, John, I do. Well, with that, my curiosity was piqued because I knew he didn't have a pension. So I asked him, I said, you don't have to give me numbers, but could you tell me what kind of a plan that is? And he said, well, sure. He goes, I have a 401k with almost $1 million in it. And I had to tell him, doctor, that was not my question. My question was, do you have a plan in place that will guarantee you will never run out of money in retirement? You have $1 million. That money hasn't been taxed yet. How much of it do you get to keep? He was, well, it's all mine. Well, it's not. You're in business with Uncle Sam. So if you're at the 30% tax bracket, what do you have? $700,000? And you live a nice lifestyle. So if you spent $70,000 a year to maintain your lifestyle, you basically would be broke in 10, 11, 12 years max. Imagine returning to work at age 80. Or maybe you're not physically able to return to work.
Wow, John, that was great.
So you see, Dr. Fine, my goal to bring in financial literacy to all is crucial. There's so many people who lack this knowledge or that are working with incompetent professionals. I highly recommend that everyone seek advice from a professional that does a needs analysis before recommending anything, and one that knows how to help build and protect your money, income, retirement, and assets.
Everything today you said is really great advice, but what else would you like the viewers to know or consider?
Well, I'd like to close by posing a few questions to the viewers. How do you feel about your retirement? Do you feel comfortable, or do you have some doubts? Do you currently have a plan in place that will guarantee you will never run out of retirement income? If you are saving for retirement, are you doing it in the most tax-favorable way? Are you working both to build and protect everything of value to you? Are you working with a professional that keeps up with education and training in their field? Do your advisors offer free education and advice that doesn't earn them a commission? Are your advisors working strictly on what they learned years ago? Or are they continually seeking better ways to help you? And finally, Stan, I would ask your audience these questions. Do you really believe that the bank is the only place where you can safely accumulate money? If so, you need to call me. Would you like to learn how to become your own banker? Are you tired of paying Uncle Sam taxes on your retirement savings? Are you tired of paying multiple insurance premiums for benefits you might never receive? Would you like to earn more interest than you're paying out? Would you like to increase your retirement savings without setting aside more? If so, you need to call me. And if you are one of the few people that's receiving a pension at retirement, do you know which distribution option to choose, A or B? Because the wrong choice could cost you thousands of dollars in future income. For free information and help, or to set up an educational workshop for a group or a business or even individually, please don't hesitate to call me.
Is there anything that you'd like to share with the prospective clients that are watching today?
Well, you know, Dr. Fine, the very first thing that I tell prospective clients is that I will never ask them to buy anything from me. And usually they'll respond with, well, isn't that how you earn a living? And my response is no. I make a living if they buy. I educate them and they make an educated decision to buy. I don't need to sell them anything. So you see, an educated consumer is my best client.
So today you've been listening to the Business Doctor TV show, and we've had as our guest John Rivers of Straight Talk Financial in Boca Raton, Florida. We strongly urge you that if you have financial questions and you're looking at your future, he's the gentleman you really need to talk to. Thank you. John, thank you for coming on.
Thank you for having me, Doctor.